Hello, everyone, and thank you for joining us. My name is Amanda Kramer, and I am the Alumni Engagement Program Manager at the University of Colorado Boulder's Leeds School of Business. These are certainly trying times, and here at CU Boulder, we have gathered our world-renowned faculty and alumni to provide frank and timely insights for life during and after the COVID-19 pandemic. Today is the 7th of 8 webinars in this COVID-19 related webinar series. To view upcoming webinars, please visit our website at colorado.edu/business/alumni. Click the drop-down arrow and click Attend Online Webinars. For today's webinar, we're so excited to welcome back Leeds Associate Dean and Senior Economist, Dr. Rich Wobbekind, and Executive Director of the Leeds Business Research Division, Brian Lewandowski, here presenting a COVID-19 economic discussion, What We Know. A few housekeeping items before we begin. First, if you have any questions now or during the presentation that you would like to ask Rich and Brian, please send a question through the chat interface. We will monitor questions as they are submitted, and Rich and Brian will respond to them at the end of the presentation. As a reminder for optimum audio quality, we do have everyone on mute except for myself and our speaker. If you experience any technical difficulties during this webinar, please notify us through the chat interface and one of our support specialists will touch base. Lastly, a link to access the webinar recording will be sent to all registrants tomorrow, along with a survey link and supplemental resources from today's presentation. Now, I am excited to introduce today's speakers. Associate Professor Richard Wobbekind holds a PhD in economics from the University of Colorado Boulder and is, amongst many roles at the university, Associate Dean for Business and Government Relations, Senior Economist, and Faculty Director of the Business Research Division. As Faculty Director of the Business Research Division, his responsibilities include developing an annual consensus forecast of the Colorado economy and performing various economic impact assessments of the Colorado economy. Wobbekind also produces the quarterly Leeds Business Confidence Index for Colorado. Rich is joined today by Brian Lewandowski, Executive Director of the Business Research Division at Leeds. Brian specializes in economic and revenue forecasts, policy studies, and economic impact analyses. Welcome, Rich and Brian, and thank you so much for being here. I'm going to hand the webinar controls over to you now, Rich.
Of webinars in terms of looking at the economics of what do we know so far. The title of this is intentional. It's not the COVID economic forecast or it's not a solution to the problem. It's really a discussion, what we know from the data that we've seen, and where do we think we're going to be going from here. I would highlight, there are many people who were not on the discussion a month ago from all parts of the university, from other schools and colleges who were invited to this seminar. We're really pleased to have you on board and to have you listening in to this discussion. I'd like to highlight two things. One, we took questions in advance and we are building some of the responses to your questions into the presentation. So hopefully that will be obvious as we go along. And because of that, I'm going to be looking down at my notes a little bit every now and then. So I apologize for that, but I want to make sure I don't skip over some of the points that we're trying to add to the presentation. Secondly, for the people who watched it a month ago, some of the slides will look the same, but the data will, because we're a month further into this, we know more about what we're actually seeing out there, and we can elaborate on that in greater detail. But before I do that, let me just ask you as buffs, this is an incredibly difficult time for everyone, and we know that, and I know that. But it's really difficult for our students. And so anything you can do to help our students would be greatly appreciated. We have students looking for internships. We have students looking for jobs. We have students that are going to have great financial stress because they lost their internships and they lost other things they were doing to support their education. So anything you can do to help our students, that would be absolutely great. Okay, so moving along. We discussed this last time, is this a black swan event, the so-called thing you can't expect? There's been a lot of sort of discussion of that as we've gone along. And I think you could argue in both ways. I kind of argue it is a black swan because we've never really seen anything at this magnitude. There was SARS, but it really wasn't at this magnitude, and particularly because we've never had the government totally shut the economy down as we have with this particular experience. Shutting the economy down and bringing it to an extreme stop, which is data you're going to see as we go through this presentation. No easy comparisons in history, no easy way to say, how do you fix this the next time? I'm very pleased to say, I think we learned from the last deep recession we had in 08, 09. We learned some things that worked and we learned some things we didn't do as well. I'll kind of comment on those as we go along. But this is all part of, feeling our way forward. So our fundamental sort of view here is that we know we've had exponential growth in domestic cases of COVID, but the economy was on really strong footing prior to that. As you can see from the bullet points, the economic data lags, but we've got a lot of data now to sort of substantiate things that we're seeing. Federal policies are helping, and I'm going to talk a little bit about that towards the end of my comments before I hand off to Brian. Select industries are bearing the initial brunt. I think part of what people are interested in is what's the secondary brunt. The Colorado economy on a particularly strong footing, as many of you know, a very, very strong footing, and a large chunk of this audience is from Colorado that's listening in. And then overexposed to some of the downturn, but well positioned in other areas. So talk a little bit about that as we go forward here. So this is a relatively updated map of COVID cases, and as you can see, the US over 1 million, and Spain the next closest at under 250,000. So the US has rapidly overtaken us and overtaken the world in becoming a sort of hotbed of COVID. And you can hypothesize or make comments about all different reasons why that might be possible or happening, but certainly we are very mobile. We travel a lot to other parts of the world, and people from other parts of the world travel to us, and we like to congregate, and we certainly have a certain sort of level of freedom. So I skipped over one of my opening slide comments, and I want to say it now. This is a really contentious issue, health versus the economy, and you know this, you're reading it in the paper, you know the political things going back and forth. I'm bound to say something here that is going to potentially offend somebody that's listening to this to this discussion today. So please be clear, these are my views, not the views of the University of Colorado. I'm speaking for myself when I talk about these things, and what I call the gentle balancing act that we're facing, and you can we can discuss that more maybe in the Q&A if people have other questions. Colorado may be not surprising to those of us who live here, but certainly when you think about it from around the country, you look at the number of cases in Colorado, and on a per capita basis, greater than on a pure basis, greater than Washington, but on a per capita basis, greater than Texas. I mean, I don't know exactly what it is, except that we get so many international tourists. Again, we like to recreate and do things, but for whatever reason, and international travel, but for whatever reasons, Colorado has had its fair share of cases. The governor has took a pretty strong position, as many of you know, and the governor has more recently announced for the reopening of the economy, but again, allowing for local areas to make their own judgments on that. So going back to the comments about being in good shape, going into this, we're looking at potential GDP in the economy was actually, real GDP was exceeding potential GDP, and I'm sure many of you know what that means. So basically, we were at full employment, the economy was on very strong footing, And we were going into this thinking, this is going to be a slower growth year, 2020, because frankly, we don't have any extra resources. We had 3.5% unemployment rate nationally, and even lower in Colorado, which Brian will talk about later. So we went into this on this incredibly strong footing. Well, now we've seen, again, this slide reflecting some of the same piece. We're seeing this potential GDP being, very, very close, and all of a sudden falling off the cliff. So you may have seen the announcement yesterday of first quarter GDP came out. It was slightly less than -5%. So we had a negative GDP for the first time in a long time, negative GDP growth since the last recession. And the projection going forward, if you can see that blow up in the top right-hand corner, or you can see it on the main graphic, is for a fairly dramatic drop off in this kind of -30% range in Q2. So we're really seeing the economy coming to this incredible, halt, screeching halt. Of course, we've been shut down for the vast, pretty much most states have been shut down for all of April at this point. And again, we're slowly going to be bringing in some kind of recovery to the economy over the quarter ahead and the second quarter after that. We see a significant bounce back in the third quarter. You're going to get sort of that rebound. But then one of the scenarios that we're looking at is actually slower growth the 2 quarters after that before getting to higher growth trajectories. So when people talk about these types of recoveries, they're giving them different letter names or other types of names. So there were several questions that related to this. So I wanted to just sort of give this a little bit of depth or detail. We're talking about this, or we're looking at, this is kind of what they refer to as a W, a pretty, a bounce back that's somewhat significant, but then also sort of a second effect of having the economy reopen and seeing more cases surface. And so you have a weaker sort of quarters after that. Tying it together maybe more loosely with what we are commonly thinking about this, we don't see certain parts of the economy coming back until there's a vaccine in place. You're not going to see the large sporting events and other things coming back in any significant way. You're not going to potentially see people in, say, my age bracket running back to restaurants, even though we love restaurant meals. And so this is sort of, it takes longer to get a significant amount of those other things back in place. So those are sort of things that will take longer recovery, leisure and hospitality industry, et cetera. So we'll talk more about that as we go along, but just keeping my eyes on the time here, I'm moving this along a little bit more rapidly. We saw a dramatic drop off in the employment numbers. We expected that. The April numbers, which are coming out tomorrow, we'll see the May 1st release of the April numbers will be even more dramatic, likely to be even more dramatic just based on the initial unemployment claims we've been seeing filed every week. And this is, things we haven't seen. This will be numbers that we haven't seen since the Great Depression in terms of the dramatic downturn in these numbers. The unemployment rate last month already jumping up to 4.4% from 3.5. This is on its way up in the summer to a number in the 15% range or beyond. So double-digit inflation, double-digit unemployment, and much higher unemployment rates than we saw in the 2009, 2010 timeframe. And quick up, and not the super quick down, but starting with a movement down as the economy reopens. So it gets up and then it sort of works its way back down. And differing forecasters have different opinions on this, but probably below double digits by the end of the year, in the high single digit range by the end of the year. Now, again, reasonable people disagree on this, but that's where we're there. So In terms of the recovery, we're talking about a recovery in terms of months to recovery. You can see on the right-hand side of this graphic for the various recessions that we've had. You can see more recently, we've been 50 months almost for 2001 and up in the almost close to 80 for the 2007 to 9 recession. We're talking about a recovery here. Again, this varies by forecaster, but 30 months to get the jobs back, some people 36 months, but we're talking about a shorter recovery in terms of employment recovery to get back to the same level of employment than we've seen in the last 2 recessions, and potentially even in the last 3 recessions. So not the quote jobless recoveries that we've seen in the more recent recessions. Again, this highlights the initial unemployment claims just came out this morning. You can see that these initial claims have been falling the last couple of weeks, but you can also do the numbers in the month of April. You can do the math there. 20 million people filed for unemployment. In the end of March, another 10 million. So we've seen, since this sort of kicked off, 30 million Americans file for unemployment insurance, and this is not over yet in terms of we'll still see more claims coming in the weeks ahead. So that's why people are looking at this and following this. This is why the government has spent a fair amount of money trying to make sure that all of these people are covered. We'll talk more about that in a moment if you're not familiar with that as we go forward. So a couple of things that are going to need to happen as we come out of this recovery. The consumer has to be able and willing to go out there and start to spend again. There will certainly be some pent-up demand. We're tired of being in our homes and we want to go out there and do some things. So there'll certainly be some pent-up demand. But as I highlighted, there'll also be some of this psychological stuff going on. When do people feel comfortable again? This consumer confidence index on the left-hand side just came out yesterday, and we see that the confidence dropped dramatically. And one interesting sort of sub-piece of this is that the mountain region confidence, which includes Colorado, is actually lower than the United States consumer confidence right now. And that has historically not been the case. There's only been a couple of times you can see the chart where the Rocky Mountains have not been sort of more optimistic about the future. So another good piece of this is that the confidence index asks you about current situation and also about the future situation. And the future expectations were stronger, much stronger than the current situation. So the consumer is saying, or the household is saying, they think things will be better 3 months out, 6 months out than they are now, that their future expectations for 6 months are definitely higher. That's a good sign. And actually that number went up from last month to this month. So the consumers, I guess, seeing more of a light at the end of the tunnel, if you will, as we start to see the economy reopening a little bit. The ISM these are national surveys of business, and of course we need business confidence to come back. This is not released, the left-hand one, manufacturing in particular. We've seen surveys that are more regional from around the country plummeting in the last month. The survey for the ISM, excuse me, for April does not come out till tomorrow, May 1st, and the estimate is that number will plunge to 35. So we're going to see, again, a confidence number from the business sector that is going to be down and very much in parallel with the 2009 economic recession. Our own confidence index, excuse me, which came out earlier in the month, the beginning of April, based on March data, showed our lowest reading that we've seen since the Great, even lower than the Great Recession back in 2008, 2009, but also indicated in the 6-month time frame that businesses were less pessimistic. They thought as the economy started to open up again, things would be getting a little bit better. So one of the things that's going to need to happen, I mentioned, you know, the employment numbers are not going to be pretty for the 6 months ahead. So one of the things for consumers to get back in the game, of course, is they have to be confident with their wealth. And we have seen a pretty nice bounce back off of stock price lows. This chart gives you a picture of that after seeing the incredible crash in March and a lot of concern about consumption patterns in March, how this was going to be impacted by not only, again, incomes, but also by wealth of people who were still working, but worried about their retirement accounts, whatever else it might be. We did see personal income fall in the month of March. That just came out today. And we also saw, and I guess not surprisingly, a big jump up in the savings rate to over, excuse me, to over 13%. So as we look at the overall picture, again, and interestingly enough, as you can see, the NASDAQ actually higher than it was this time a year ago, but a broader index of the economy, and one that's probably more worth watching, is the Russell 2000. And the Russell 2000, again, is down, as you can see, both from its peak of 22%, but even almost 16% from a year ago. So interest rates are a question people have, a lot of people had to ask about, where are interest rates going? And the view here is that interest rates stay low to stimulate the economy, and honestly, probably stay low for a 2 or 3 year time period. So we're looking at interest rates not starting to move up, even with all the federal debt that's been floated and so on. We don't see interest rates really starting to move up until probably the 2023 kind of time frame, late 22, early 23. So really, when that employment number comes back, but I mentioned earlier, you're thinking maybe 30 months to get the employment number back to where it is in sort of a basic sort of thought process. Well, if it's 30 months from when we start seeing employment recovery and in July, then you're talking about the rest of 2020, 2021, and 2022 before you get back to the same sort of employment level. So if it takes you to the end of 22 to get to that same employment level, say that 30-month time period, I don't think you're really going to expect to see too much movement in interest rates before you see that employment recovery occur. The federal budget, largely negative, as you can see, and getting worse. This has, quickly escalated. I consider myself someone who's somewhat of a deficit hawk, but no one disagrees in this particular case that the government is doing the right thing in terms of helping to bail out the economy. And so you can see in this particular graph that the projection is that we're going to be debt to GDP is going to hit that 100% mark, and it could easily pass what it was post-World War II in terms of the highest ratio ever. But dealing with that's going to be left for another day, a day after the economy actually recovers and we can get past the vast numbers of people who are unemployed in the economy. The other part worth noting is that, of course, the Federal Reserve is holding on to the debt much more so than they were a decade ago. Their position has gotten larger, so have other types of investors' positions gotten larger as we look at 2019, and more of the debt is being held domestically than in prior times. So more of that is internally held, which is generally considered to be a good thing or a positive for a country. So the CARES Act, you've heard about it a lot. I'm not going to speak to it too much. I think it's gotten a lot of positive reviews, some negative reviews around the unemployment benefits and whether they're too that's too much money going to from the federal government going to unemployment benefits, and whether or not that's excessive and whether or not that's going to discourage workers from coming back. That is one of the challenges, and something maybe we can talk to more in the Q&A part a little further along. But I would highlight that there was not enough money in this particular bill for the small business loans. Last week, of course, the fourth piece of the fiscal project was passed, and that's providing additional loans for small business. What's still hanging out there is the state and local government finance issue. So if you tallied up the first three pieces of fiscal stimulus and add what happened last week, was piece number 4, we're up at $3 trillion in total at this point, which is 15% of GDP. And compare that to 2008, 2009, we did a total of, the highest we hit was 10% of GDP in terms of the ARRA, if you remember that, the Recovery Act from the last recession. So this is substantially more stimulus as a percent of GDP than we had a decade ago. The next bill is going to come, and the next bill could easily be another $1 trillion. I suspect it's a few months out at this point. I'm telling you, I think it's going to need to have state and local government finance as a focus. It's certainly going to have infrastructure spending as a focus. We're hearing that part already. Through the middle of 2021, we believe, and a lot of other people are forecasting this, but through the middle of 2021, it looks like at the state level, there's going to be state budget deficits in the $200 billion range around the country. We're looking at Colorado's very closely. We could talk more about that if we have that question at the end. But $200 billion is just a whole lot of money. So as we close out, people are asking what's taking the hit, and the question that a lot of people want to know is where to be in the recovery. So you can see clearly what's taking the hit in the first wave: accommodations and food services, healthcare, and retail, things you would expect. When we look at the jobs added by industry for the year, you can see that those areas are the ones having the biggest sort of losses, along with manufacturing, construction. So we start to see a slowdown in other sectors. And then moving forward to 2021, we start to see recovery, construction, wholesale trade, healthcare, and social assistance. You start to see some of the things at the top. Everybody's damaged. I don't know who. Healthcare, I think, recovers sort of the first. But going forward, I think the interesting questions are maybe not necessarily the industry, but the geography and the characteristics. So I think education remains at a premium, and tech remains at a premium. So maybe you could say that's, and I certainly think healthcare and biotech are going to be, come out of this really strong, because people aren't going to forget that quickly. But I also think places that have a lot of population density that have suffered badly from this, New York City, San Francisco, and so on, I don't know how easy it is for those areas to recover, or those areas to be as desirable. Said differently, are you going to see a migration out of those places to other parts of the country that are less densely populated? And if that happens, the firms are going to follow where the employees are going. So I think you have that kind of a sort of back piece, and Brian can sort of talk a little bit more about that. So right now, transitioning over to Brian, and I apologize for taking a little long, Brian, but Brian's going to take over and talk to you about Colorado.
Okay. So I'm going to transition us kind of from a global and national discussion down to a Colorado discussion. And I like to start by talking about some of the economic metrics that we've been tracking in Colorado pretty intensely since the Great Recession. And one thing I like to point out is that we have truly had one of the best economies in the nation over the past 10 years. So if we're looking at things like GDP growth or employment growth, personal income, per capita personal income, home price growth, low foreclosure rates, labor force participation, almost anything we look at, Colorado has been a leader nationally. We've been in the top 10, the top 5. We've even occasionally been the leading state. So when we take a look at personal income in 2019 for the full year, not just a single quarter, Colorado had the fastest personal income growth. And for the full year of 2019, we had the second fastest GDP growth. So the chart in front of you is showing you some of the quarterly growth year over year. So it's been a pretty remarkable run in Colorado. The frustrating thing when looking and tracking some of this economic data, as Rich alluded to, is that a lot of this information lags. So we can certainly point to evidence in our own experiences in Colorado of the recession hitting. Stores are closed, people are working from home. But a lot of this doesn't really show up in the economic variables yet, except for maybe unemployment, a little bit of the jobs data, and initial jobless claims. So I'm going to start by talking about initial jobless claims in Colorado. We just got some new numbers that were released this morning. We had about 40,000 more initial jobless claims in the state for the week of April 25th. And when we add on the federal pandemic unemployment assistance program, which brings in our gig workers and our self-employed workers, which have never really been covered by unemployment insurance in the past, the state has estimated there's another 41,000 people over the last 6 weeks who are applying for those benefits. So sum up the last 6 weeks under the traditional unemployment insurance program, and we have 340,000 residents in Colorado who've applied for benefits. This is a good leading indicator because as people are furloughed or as they lose their jobs, one of the first actions that they take is to almost immediately go out and apply for benefits. If we tack on the gig workers that have applied, that's 380,000 residents in Colorado. So to provide some perspective, if we divide the 340,000 by total employment in the state, that's about 12%, which is somewhat of a leading indicator for what we expect with the unemployment rate. We saw a jump this month from under 3% to 4.5% for Colorado's unemployment rate. And this is the first time in a long time that we are higher than the national rate. A couple more interesting things about the initial jobless claims is we do see that there's a plurality of workers who are between 25 and 35 years old who are applying. We certainly see increases across all age cohorts, but that's where we see the most claims coming in. And we also see more regional differences when it comes to claims, and we see more women than men applying for benefits. So when we take a look at the distribution across the state, this won't really shock you too much, I think, because we see on the heat map that there's a much greater rate of jobless claims filings in our mountain resort communities. We certainly saw the tourism industry get hit early and get hit hard with the shutdown of many of our tourism amenities, like the ski resorts. But just to provide a little bit of perspective, if we take a look at places like Park County, Lake County, Clear Creek County, San Juan, San Miguel, these are some of the places where we've seen the highest share of jobless claims to overall employment. But if we even take a look at places like Boulder, Denver, and Broomfield, it's not to say that there's a lot less pain in these areas, it's just a lower percentage of the total employment in these areas. And when we look across industry, we've seen the most claims early on be filed in the tourism sector, again, so accommodation and food services. These are hotels and restaurants. We've seen a lot of claims in retail trade as much of our retail sector has been closed. We've seen a lot of claims in other services, which include things like barber shops and hair salons or nail salons. Also, mechanics, we've seen a lot of those furloughed or shut down in the short run. An interesting one when it comes to jobless claims by industry is just thinking through the healthcare sector, because on one hand we have healthcare, which is on the front line of the health crisis, but we also have a lot of healthcare that is non-essential. So things like dental offices or orthodontists or general practitioners who have really been shut down like many other industries in the short run. You know, we've been asked about if our professional sectors have been impacted, things like professional and technical services. So these are engineering, research and development, software programming. Those have certainly been impacted, and you can see about halfway down in this list that there are still, you know, thousands of claims within that industry. But when we convert this to a percent of the overall employment by industry within the state, the double-digit percentages of jobless claims are still in these first sectors that I mentioned. So retail, hotel, restaurants, and other entertainment sectors. If we take a look at it for the information sector or for those engineering sectors that I mentioned, or even company headquarters, those are all sub 3%. When we look at it for the finance and insurance sector, that's sub 1% right now when it comes to initial jobless claims. When we walked into 2020, our forecast last December was that Colorado would continue growing, but at a slower pace. So we were forecasting about 40,000 jobs for 2020. And we called out that this was the lowest number of jobs added since 2011 and the lowest percentage growth since the Great Recession. Of course, we have drastically changed our tune in the face of the COVID pandemic. Now we're looking at what we think is minus 160,000 jobs in the state in 2020. And you can look back to the Great Recession on this slide and see that that number eclipses the job losses that we saw during that event. But what's different is we are optimistic that we start to grow jobs again from this much lower base in 2021. And it'll still, as Rich mentioned, we think it'll take 30 months, 36 months, maybe a little bit longer to get back to par to recoup all of those jobs lost. But if it is 30 or 36 months or 40 months, that would still be a faster recovery than what we saw during the Great Recession, or even from the 2000 and 2001 recession. I've already mentioned that our unemployment rate ticked up drastically in March. Soon we'll be able to see the April number. And we think that the April number will start to really show the true colors of how deep and hard-hitting this pandemic has been on our economy. One thing to note when we take a look at the employment growth rates and the unemployment rates, this is really based on a survey from the 12th day of the month. So we're not capturing the true shutdown that we saw in the month of March. We're only right now seeing data through the 12th day of March. And think of everything that changed after the 12th day of March. So at that point, we had a couple of school districts starting to shut down, but the lockdown orders from the governor came almost 2 weeks later. And we hadn't seen the ski resorts shut down yet. We hadn't seen restaurants shut down yet. So when we talk about a 4.5% unemployment rate, or we talk about our job losses by industry, it's only reflecting the early part of the pandemic's impact on the Colorado economy. So we're expecting 160,000 jobs lost this year. Just to convert that for you, Colorado is a high wage state. We're the 11th highest paying state on average across the country. We're at about $61,000 per job. What that means is for every 16,000 jobs that we lose, that equates to about $1 billion in lost income, which equates to $1 billion in lost consumption ability, pain for families who are trying to pay their mortgages or service their student loans or buy food, things like that. And the unemployment insurance benefits, even though they're more generous than they have been in the past, for many people, this doesn't make them whole on that lost income in this period. I mentioned the job losses and the initial claims by industry, and I want to illustrate a couple of things about this. One, just want to point out that accommodation and food services, retail trade, our entertainment sectors, and other services, we really view those sectors as being the front line of the economic crisis. We also note that these are the 4 lowest paying industries in the state. So what this chart is showing you, right in the middle, there's that gold bar that's showing you all industries, 2.7 million workers with an average wage of 61,000. All of the industries below that bar are the below average paying industries, and all of them above are, of course, the above average paying industries. When we take a look at the below average paying industries, when we get down to hotels and restaurants and retail trade, we're looking at 24,000 a year to 33,000 a year. So considering that these were the industries impacted early, they were under lockdown early, we've seen a spike in the initial jobless claims across these industries. Also, just keep in mind that this represents 1/4 of all of the jobs in the state, and only 13% of the total wages in the state. We view these workers as perhaps the most vulnerable workers within our economy because they tend to be minimum wage or a little bit above minimum wage. They also tend to not have all of the benefits that many of our salaried professions come with. The flip side of that, maybe a more optimistic side of that, is looking up to professional and business services or finance and insurance or wholesale trade or the information sector. These are our higher paying industries, higher paying occupations. We've seen many fewer layoffs and initial jobless claims within those sectors, meaning that most of our workers in the state still have their jobs, and most of our workers still have their incomes coming in, which may be a point of optimism once the economy starts to open back up, that there is this pent up demand and people can start spending those incomes again to help us with our recovery. So what this slide is showing us is the total number of jobs in the state in Colorado in March of 2020. And we've highlighted the industries red, blue, and gold. And we look at the red industries, as I've already discussed, as being on the front line of the economic crisis. The gold industries are sort of a second wave of the economic pain. Notably, government we look at as being negatively impacted because of a loss in retail sales and use taxes in Colorado, as well as this impending loss of income taxes, both the individual income taxes and the corporate income taxes in the state. I'll talk about that a little bit more in a moment. But some of the early evidence of the economic crisis can be seen in our March jobs numbers. So this is Colorado job losses from February to March. And as I mentioned a moment ago, this is a survey that's done nationally. It's a significant sample. It's about 150,000 establishments that they survey every month. And in the past, they've had really good estimates from these sectors. But it was as of the 12th day of the month. And as I already mentioned, there was a lot of month left after the 12th where we saw dramatic impacts on the economy, where communities and industries were shut down. So when the April numbers come out, we're going to see a radically different chart in front of us, steeper losses for some of these sectors, and we expect really across the board losses when the April jobs numbers. So I'm going to focus on just a couple of industries before I wrap up. I'm going to start with the tourism sector because it just has been so top line when we're talking about the economic crisis. And when we look across Colorado, it's not really a big surprise to us to envision places like Vail or Breckenridge or Aspen as facing kind of the early recession when their ski resorts were shut down. But just to illustrate this in a slightly different way, when we take a look at tourism employment, in those mountain resort communities, it represents about 40% of the total jobs. So this is their primary industry up there. When we take a look at the Metropolitan Front Range, if we take a look at a place like Boulder, it's about 12% of employment. When we take a look at Bloomfield, it's about 9% of employment, or Denver, it's about 13% of employment. But the vast majority of these jobs are along the Metropolitan Front Range. So the Front Range actually represents 80% of tourism jobs in the state. But we have a much more diversified economy along the Front Range. So the first wave of that impact from the tourism sector being shut down, on a percentage basis, it has a smaller impact on a place like Boulder or Denver versus a place like Breckenridge or Aspen or Vail. And so when we think about a recovery and we think about restaurants being able to open back up, we also see the restaurant industry, for instance, recovering faster along the Metropolitan Front Range because the Metro Front Range restaurants are really serving a local community. They're largely serving local residents, of course, with visitors coming into their restaurants as well, but it's mostly local residents. Whereas our mountain resort communities are really serving an external customer, these visitors coming in from other states or from across the globe. And so the mountain resort communities thus are more dependent on a national recovery or a global recovery. People being comfortable, again, traveling to Colorado, getting on a plane, coming to Colorado, being comfortable, being shoulder to shoulder at concerts, those sorts of behavioral things that we're really not certain how people will respond coming out of this event. Another thing we've been thinking a lot about is the energy sector. When we think about the oil crisis that we're in right now, it's been driven by two main factors. One, we saw a price war between Russia and OPEC early on in this event, which really drove down oil commodity prices. There was some resolution there to cut production, but that really didn't have a meaningful effect on oil prices. The second thing that we've seen is demand just really evaporate for oil. And you notice this if you're out on the roads, there isn't any sort of traffic congestion. We've seen gasoline prices fall below $2. So without this demand, we've seen inventories spike nationally. We're pretty much out of storage. We saw the oil futures price actually dip below zero last week, and we've seen it rebound since, but it's still at a very low level. And when we see really low oil prices, we see the rig counts fall, and that's what you can see on this chart is this sort of loose correlation between oil prices and the rotary rig count in Colorado. So after the rig count falls, we also see job losses within the sector, and you can see this if you look at the WARN notices, the worker adjustment and retraining notifications that the state publishes. Layoffs have been noted within the energy sector. And eventually there's a lag effect, but we'll see production fall. So this is a worry, especially for places like Weld County. They produce 90% of the oil that comes out of the earth in Colorado. And lastly, I just want to touch on retail sales. So this is another indicator that we can't really see for Colorado, but we can see what's happening nationally and relate that to Colorado. So month over month, we saw a record fall in retail sales nationally. They fell 8.7% over the month, fell 6.2% year over year. It's the fastest decline we've ever seen. When we peel back the onion though a little bit and take a look at the subsectors of retail that changed, we saw a record fall in things like clothing stores. They fell 50%. We saw about a 26% decline in restaurants and bars. We saw a 27% decline in furniture stores and motor vehicle sales and motor vehicle parts stores. But we saw an increase in grocery stores, and the increase was about 26%. We saw an increase in health and personal care stores. So think of the Walgreens that are out there. Those were up about 4%. And we also saw an increase, a very small increase in building materials stores. So like Lowe's and Home Depot's noted a sort of increase for the month. But we can relate that to Colorado's economy and ultimately to Colorado taxable sales. We tax goods in Colorado at the state level. The state does not tax food and beverage stores or grocery stores, but some local municipalities and counties do. But you can sort of start to relate that to the state budget. If clothing sales fell off 50% and if furniture sales fell off 27%, et cetera, you can start to see how that chips away at retail sales taxes within the state. And lastly, when we look at the retail sales taxes in Colorado, Colorado has a very disaggregated tax structure. So when we're looking at the state sales and use tax collections, that's actually just a minority of the sales taxes that's collected in the state, because most sales taxes is collected by cities and counties. And in fact, for cities, that tends to be the primary source of revenue for city budgets. And so that's why we see municipalities like the city of Boulder or the city and county of Broomfield that instituted some furloughs, and many other cities across Colorado, because they're seeing that the sales tax revenue stream is going away very quickly. So I'm going to just wrap it up by reminding you that Colorado was on a really strong footing heading into this crisis. We do see the tourism sector, which is one of Colorado's coveted industries, at the front line of the economic downturn, as well as our mining industry. But we do see some silver lining in some of the other industries where we do have a high-tech sector here that's very strong. And we see the information sector and engineering sectors holding up well so far. We do see that federal assistance will help soften the blow to some extent, but it's becoming more and more clear that there needs to be some sort of stimulus package to help state and local governments in very short order. So I'm going to stop there and see if we have time to take a few questions.
If I could just make a comment, I'm looking at the questions as they're coming in. So one of them was a question I was supposed to be answering in my front piece, and I apologize, I sort of skipped over this. So person asked about why are we hopeful that the recovery here is going to be shorter than the Great Recession in terms of the jobless recovery versus the 30 to 40 month time frame, whatever that might be. And the answer to that question is that the 2008-9 recession was a financial recession. We lost a great amount of the banking system during the financial support system, and so we not only had to heal the basic economy, but we had to heal the financial system before we could heal the basic economy. This time around, the Fed has been so aggressive, they're just refusing to let the financial system become unstable. We didn't have a lot of the financial excesses going into this downturn. The economy was on pretty strong footing. The debt ratios were pretty good for most parts of the economy. State and local governments were on solid footing going into this. So when you put it in that context, you really just need the economy to get back and going again if we can keep the financial system well lubricated behind the scenes. As I suggested, the Fed has been just refusing to let the system go down, providing just incredible amounts of liquidity. It also ties into another question that was asked about the ultimate size of the debt and what does that potentially mean for inflation. I mentioned interest rates not moving up for several years, at least you could argue based on the employment recovery. I also think at the end of the day, that's when you start to see potentially more inflationary pressure in the system. But right now, the issue is probably larger with deflation in the system than it is with inflation in the system, just given the fall off in purchasing power and all the things we've seen in the last 8 weeks.
Great, thank you, Rich. And as a reminder, please feel free to continue to submit questions. We will go a little bit past 1 today. And then what do you attribute to the lower level of consumer confidence in Mountain Region versus the US overall?
Well, certainly, from that initial piece, you could see Colorado had a larger, had more than its fair share of COVID cases. So that could be part of it. Part of it could have been the sort of aggressive response. But when you think of the other states, like, for example, Arizona or some of the other states that are tourism based, I'm sure they're feeling that the tourism industry is going to be, last one back on the boat, so to speak. So when we're looking at, the recovery, I think those of us who are more dependent on tourism in the country are going to be saying it's going to be a longer road back. In Colorado, we didn't really highlight this too much, but obviously, DIA has been this incredibly huge engine for the economy, and now it's 95% of what it was doing a couple of months ago. So those of us who are dependent on more tourists and more travel, I think it's affecting us. The other piece, of course, is a lot of the mountain states are energy states, and so when we look at the energy prices, what's going on in the mountain states is also affecting that.
Okay, thank you for that. We have another question from Ben. What can we do in the future to prevent large economic loss in an event like this?
Well, I would say you got to get out in front. Well, what we found out from this particular event was, we didn't have the ability to do medical response. We didn't have capacity. And then when we tried to figure out the supply chain, we found that we were, couldn't put together testing kits because things were coming from all these different places. So we have to sort of revisit some of the supply chain relationships and some of our commitment to healthcare. There was a comment that this, in terms of the severity of this at this point, it's not much different than a bad flu year, which so far that is true. But I think what freaked everybody out was that the rate at which this could have expanded without the quote social distancing or masks was that it was going to totally overwhelm the healthcare system. So we have to be prepared. We have to be able to respond to this, and that's why I think healthcare and bio, they've gotten more money sent in their direction already this year than sort of normal years, and I think they continue to be an important part of what we face going forward.
Great, thank you, Rich. Next, we have a question from Deborah. How do current trends impact CU?
How do the current trends
impact CU? Some of these trends that we're seeing in the economy.
Well, just in general, one of the things, of course, I was trying to say at the front end is, try very hard for our undergraduates and our grads that they have internships in the summer, or internships during the school year, and so the trends away from people being able to go and actually do a physical internship in a building, which is really what's hurting us quite a bit right now, it's obviously problematic. That's a short-term piece. The long-term piece, I actually think that people with higher education levels are going to continue to be at a huge premium. People who can use technology, people who can do remote work if necessary, and we're training people in those skill sets, not just in Leeds but across the university. So hopefully that translates well to the economy of the future, as opposed to the economy we just left.
Okay, great. And Rich, you referenced this at the beginning. We are getting several questions specifically on unemployment. Claudia asked, I've read and heard low-wage employees are making more money from unemployment payouts than from their old job. Could you talk more about this, especially as companies start to offer those employees their jobs back and they may not feel comfortable going back to work?
Yeah, so that's the big issue. Normally, or at least as I understand it, this is not an area of specialization, but normally when a company, so when you file for unemployment, you have to be actively seeking to get reemployed, even if not with your company, but with another company, whatever. You have to be actively seeking to get a job. So clearly, when your company tells the unemployment people, "Hey, we're calling Rich back to work," then the unemployment office or Colorado Department of Labor and Employment knows that, and they have that information, and that typically would put in sort of a termination, if you will, of your unemployment benefits. You've been called back, you no longer qualify, you're done. But this is a little bit different. So there's two confounding factors here. One, normally unemployment benefits wouldn't be as great as they are now. The state has reasonably good unemployment benefits, but the federal additional amount of money from the federal government of $600 a week really makes unemployment benefits enough to live on. I mean, combined in the state of Colorado averages about $450 a week, and the federal 600. So people are making over $1,000 a week on unemployment, and that's not those lower wage brackets that Brian was showing on the slide. They're not a $50,000 a year job. So people are going to be making more in this structure than they would have made at the job. So one thing is just there's a lot of money. The second thing is, and very legitimately, and I think this is what the question was, the second piece is, do people feel comfortable going back to work, or are they at more risk going back to work? If I'm on the front line, I'm in a higher risk category personally, so age-wise. So when that's something else that the state's going to have to work its way through, the labor and employment people, and I think that piece is extremely difficult. Is the person legitimately going to be put at risk or not? If the firm is following procedures, if people are wearing masks, if they're separated and all of those things, how do you make that call? And I know, because I just listened to their call this morning, their teleconference, that they're working on this, but they know this is a difficult situation, but they're working on it. And other states are being somewhat more forceful and saying, you got called back, you're it's time, you're done. But I think each state and each Department of Labor and Employment is going to have to sort of figure out what fits in the federal guidelines and how can they address that.
Great. Thank you for the clarity on that pressing issue. We'll take a few more questions and honor everybody's time. We have a question from Stephen here. What is the reality that states could or should file for bankruptcy, and what would the economic impact be?
I don't know enough about public finance. I mean, the reality is, of course, your debt is the debt that you're financing is going to go to junk grade or whatever. So that's really the big sort of financial impact. But I don't know what the going forward impact is. I mean, the state's got a balanced budget restriction, as almost every state in the country has a balanced budget restriction. So beyond spending down the rainy day fund, I think the state is obligated not to file for bankruptcy, but to cut programs to cover. Where that begins and ends, I'm not sure, but cities have filed, as I'm sure the person asking the question knows. We've seen cities file for bankruptcy and come out of it on the other side, but I don't know that we've seen states file for bankruptcy. So it's a big issue, and that's why I'm suggesting this is a great controversy, and I'm sure some people at least are following this and who are on the webinar today. The federal government is debating this in Washington quite a bit, because some of these cities and states went into this in really bad financial shape, and the Senate and Congress don't want to bail out bad fiscal management in parts of the country that's existing. But then there's places like Colorado, it didn't go into this in bad shape, but because of how bad this is, and potentially I don't know yet the impact of Tabor on this, but of course we have the Taxpayer Bill of Rights. We're the only state that has something like that in place. So it'll be interesting to see if that has any comes into play at all in the recovery piece as well.
Great, thank you, Rich. We'll move into the final two questions here. Do you think local governments will face massive layoffs or closures due to the lagging revenue losses, and will that be indicative of the macroeconomy? John asks.
Brian, do you want to take that one?
Well, I mean, we have already seen layoffs and furloughs from cities across the state, and I think in a way that can just be the beginning. I think some of these communities are trying to get in front of their budget crisis that they know is coming, but for a lot of communities, they don't actually have evidence of the declining revenues yet, because they haven't received their March sales taxes yet. They're just now starting to get that data in. But we know it's going to severely constrain local budgets, and so places like Loveland and Fort Collins and Boulder and Broomfield and others have already taken steps. What we saw was a lot of the workers that were furloughed maybe were the hourly workers in the business units. So in local government, those business units could be rec centers, or they could be golf courses or things like that. So that kind of makes a lot of sense. If a lot of those enterprises aren't open, you can furlough those workers without having an impact on the level of service that you're delivering to your communities. But I think that it's likely to go deeper than that as we move ahead, where it'll be more than those service sectors that are cut. I think we'll see a lot steeper cuts in local government.
Thank you, Brian. And we'll move into our last question from Abdul. What are you most worried about post-COVID-19? Inflation, disinflation, unemployment, severity of GDP decline, national debt levels? Could you share more about what you're most concerned about post-COVID-19?
Wow, all of the above. Post-COVID-19, the inflation picture, long run, the inflation issue is certainly there. So that's on the horizon. But I think it's really the employment recovery piece, because so much fiscally is linked to that. Tax structures of state and local governments, tax structures of the federal government, getting all those pieces back in place. So the first focus, I think, has to be sort of on the real economy, the working person, and getting the employment back, so we have some financial stability in sort of the consumer section of the economy. Beyond that, some of those other policy pieces, financing the debt, potential for inflation, obviously things that are going to need to be addressed, but the first wave is employment for me.
Okay, great, thank you. And actually, before I wrap up, I want to ask Annie's question here. I think it will be beneficial for everyone on the call. Brian and Rich, can you direct us to any resources that I can use to monitor and better understand the economic situation as it evolves?
We subscribe to a lot of economic publications, and there's some that do very nice general summaries, like Wells Fargo or Goldman Sachs. The Federal Reserve puts a lot of information out there. There's a resource called FRED. So that's where I get a lot of my daily updates, and I subscribe directly to the Bureau of Economic Analysis and Bureau of Labor Statistics just to get this type of real-time information. But please, refer to us if you have any questions. We're already tracking this, so I'm sure you can reach out to me or Rich and get some updates too on what we're tracking.
Yeah, we do a quarterly, 2 different quarterly newsletters that are posted up to or linked to the website. The Leeds Business Confidence Index, which comes out the first day of the next quarter. Next one will be July. And then about a month after that, typically, we release something called the Secretary of State Report. We just released that this week. That has a lot of good up-to-date economic information in it. And then our general forecast, which will come out again in July. We'll have a mid-year update. So as Brian's suggesting, we have a lot of that data. I would refer you to our website. But the state has very good data. The Office of State Planning and Budgeting has good data on their website. The Colorado Legislative Council has good. So for Colorado specific things, I would direct you to some of the state sources. And then, as Brian highlighted, some of those national sources are really good and come out with regular updates on on a lot of the national economic variables.
Great, thank you for that helpful information. And thank you so much to everyone for joining us for today's presentation. And thank you again to Rich and Brian for this great information. As a reminder, all webinar attendees will receive an email tomorrow with a link to the recording of this presentation. To view upcoming webinars as well as previous recordings, please visit our website at colorado.edu/business/alumni. We hope that you will join us for our next webinar, which is tomorrow, as the College of Engineering's Dr. Shelley Miller presents on how can airborne transmission of COVID-19 indoors be minimized. In the meantime, have a great rest of your day and go Buffs.